Well, good afternoon, everyone. And on behalf of Chartered Accountants Cork Society, I'd like to welcome you all to our personal financial planning webinar series. My name is Stephen Kewan. I'm a partner at KPMG and a committee member of Cork Society. And it is my pleasure to introduce you to today's installment of our series. Over the course of the coming weeks, we will be hosting a number of sessions covering topics from financial planning today to mortgages, legal advice, and health insurances. Today, I'm delighted to be joined by Elaine Wilson of SurePlan Financial, who is going to talk to us about financial planning and looking to the future. Elaine is a qualified financial advisor and qualified accountant with over 20 years' experience helping clients to make smarter financial decisions and realize their financial dreams. She lives by her core philosophy, advising clients the same advice she gives herself, and works with individuals and business owners to achieve their financial freedom. So I suppose without further ado, I will now hand you over to Elaine. But if you do have any questions over the course of the presentation, please do feel free to put them into the Q&A function at the bottom of your screens, and we will do our best to address those toward the end of the presentation. Thank you.
Thanks, Stephen. Thank you and welcome to everyone to Financial Wellbeing Masterclass. I've divided the presentation into two areas. The first one is how you can improve your own financial well-being, and the second one is more technical on what you need to know with regard to changes in I suppose our financial planning area, such as changes in the pension landscape. So I'm going to switch and start sharing my slides. Now, to get started, financial planning. This presentation isn't going to make you a master financial planner. It's designed to help you make smarter decisions on your own finances. So I think the saying "carpenter's house always needs work" is the idea behind this presentation. What we're going to cover in today's agenda is long-term habits, lifestyle financial planning is my favorite area, and shortcuts to savings, which I think is very, very relevant. So long-term habits, number one is time. So if you are the accountant that does their own tax returns just before the deadline on the 16th of November, this presentation is for you. It's about making time to do your own financial planning and set your own financial goals. Now, I know we're all very, very busy, but take time out during the year to spend some time on this. Talking to some accountants, I've been told that maybe the 1st of March might be a good time for this. So while you give your own clients the five-star treatment, this is setting time for you to give your own I suppose to give yourself your own time to plan your financial goals. The second one is saving on a regular basis. So if you do any type of investing, whether it's saving for the rainy day, whether it's saving for your children's education, or more commonly saving for your retirement, by saving on a regular basis, instead of putting a lump sum in on a particular date during the year, you're buying into the market regularly. And what this does then is reduce your investment risk. So if you invested a lump sum this time last year, your investment could be down between -8 to -10, where 10%. However, if you saved on a regular basis throughout the year, you'd be in positive growth. Not much positive growth because we've had a very, very changeable year in the investment markets, but by simply investing that same money over time, you will reduce your investment risk and your money will grow better for you. The third point is diversification. Now, I always use the analogy of an auctioneer going back in the years 2005, 2008. Lots of auctioneers derived their income from property. Lots of them may have had personal investments in property, and some of them would have derived their pension growth in property by buying property through their pension. And during the crash, property prices only went one way. So having all your eggs in one basket, you're taking I suppose, more risk. More commonly or more recently, I see an awful lot of clients, working in multinationals. They're deriving their income from the one source. They may buy lots of shares in their company through their share options, and their pension is also coming from similar sources. So by having all your assets concentrated in one area, you are taking more investment risk. Now, I'm not saying multinational stocks and shares are a bad investment. Some of them have done really, really well. But it's my point being is just be aware of the benefits of diversifying. If you go to a bank and you're getting investment advice from the bank, they only have one product provider. So AIB and Permanent TSB only deal with Irish Life, and Bank of Ireland only deal with New Ireland. So if you go to a financial broker, they deal with all the providers. So you can make this diversification choice very, very simple. So if you have a pension with one provider, don't have your savings with the same provider. Or if your spouse has their pension with one provider, try and use a different provider for diversification. So these are my top 3 tips in long-term habits for improving your financial well-being. I'm going to move on now to lifestyle financial planning. With any plan, you always start with the budget. So you have money coming in, and then you have money that has to go out. The money that has to go out is predominantly mortgage, rent, or bills. Then I recommend you set aside and pay yourself your own salary. So this gives you the benefit of the benefits of money that you've worked hard for, but also gives you a little bit of discipline. So if you go out on one week, during the month, and you spend a lot of money, on that week, that means you don't, you cut back then for the next week or the week after. So it gives you the reward of your hard earnings, but it also gives you a little bit of self-discipline and making sure that you don't overspend. The third area then is left to savings, and we further divide this into 3 core areas. The first is your emergency fund, and this should always be kept on deposit. You need to keep it in a place that you can put your hands on it if you need it. The second area I call the dream fund. So where do you see yourself in 5 years' time? So do you plan on buying a new car or changing your car, buying a new house or doing renovations or taking a career break? So if this is your dream fund, or this is your dream goal, it's good to have a plan to back that up. So the difference between a dream and reality is having a plan. So if you're dreaming about it, by making a plan, you're one step further. Then everything else falls into long-term savings, of which retirement planning and pension planning is most people's long-term savings. Why pension planning is, I suppose, the best way to save in the long term is because of tax relief. So when you save into a pension, you will get tax relief either by 20% or 40%, depending on the tax that you're paying. Your pension also grows tax-free. Now, that's something people tend to forget. So if you own stocks and shares, you're going to be liable to capital gains tax on the growth. If you have an investment, you're liable to exit tax. But your pension money grows tax-free, so there's no tax applied as the investment grows. So you've got more money working for you on your behalf. And then the third tax relief is on retirement, where you can take out a minimum of 25% tax-free. So we're going to go through the different ages of lifestyle financial planning. So we're going to look at financial planning tips for the 20-something, 30-something, 40-something, and 60-something. Now, you may be someone in your 20s having saving habits in your 40s, or you may be someone in your 40s with spending habits like someone in your 20s. But hopefully there'll be some tips for everyone within this the next slides. However, if there isn't tips here for you, you may know someone that might benefit from them. So if you've got a son or daughter, starting out in your 20s, feel free to share these tips with them. So first one is live a lot. You're not going to live in your 20s. you're going to find it hard to catch up. So live for today. And if you can plan for tomorrow, do it wisely. So I recommend all my clients in their 20s to start saving in their pension. The reason for this is because I did it when I was in my 20s, and I did it by default. So I worked in the bank, and one of the girls came up to me and she said, "Have you started your ABCs?" Now, bear in mind, I was only 21, and I said, "What? Have I started my ABCs?" I didn't have a clue what she was talking about. So she explained to me your ABCs is additional voluntary contributions. It means you can put a little bit aside depending on your affordability. You get tax relief on it, which I've already outlined. And when you're older, you really, really appreciate it. And I did. So now, someone in my 40s, the fact that I started my pension planning in my 20s was invaluable. It meant that when I had it was time to take my mortgage and have my children and have childcare costs, I could step back from my pension guilt-free. And now in my 40s, I'm one step ahead. So planning, never too early to start planning for your pension, and the earlier you start, the better. Don't be afraid of taking investment risk. So because the number one tip when coming to investing is time. Always look, when do you need access to it? If you're someone in your 20s, you're not going to need access to your pension for at least 40 years. So take investment risk, give your money the maximum opportunity to grow over time. I did have one client though, right? They were in their mid-20s and all they wanted to do was put their pension in cash. Now, I didn't agree with it, but it made that person less worried about their pension, so be it. Now, 5 years on, he's gradually dipping his toes in investments, and it's lovely to see. So it's like, a child evolving over time. But that's my investment risk story. So moving on to financial planning for your 30 something. Now, this decade is the decade which has you've got most financial responsibility. So this is the decade that you keep your head down, and it's about surviving this decade more than anything. So if you have children and if you have assets, always make a will. It's really, really easy to do so. And it makes life easier for those who are left behind if something happens to you. I always back up a will with a protection plan. And a protection plan is making sure that your loved ones are looked after in the event of your untimely death, or making sure that you are looked after in the event of loss of income if you get sick. Some people looking at a protection plan are worried or concerned about the costs. So start with the budget and get good advice and ask your advisor to get the maximum value to look after these two areas. Mortgage review, really, really topical with clients at the moment, particularly because interest rates are increasing. So if you have a mortgage and you make sure you know the interest rate on that mortgage. If it's on the variable rate, go back to your bank and ask them what are the options to fix. If you're on a fixed rate already, and it's expiring the next year or two, again, go back to your bank and ask them what are the longer term fixed rate options and see if you can change from one fixed rate to another. Most banks aren't incurring breakage costs when it comes to changing the fixed rate. So it's definitely worthwhile looking into. Now, Stephen mentioned Joey Sheehan will be for Mortgages 123 will be on in a couple of weeks' time. Definitely tune into his event. He's very knowledgeable and he knows everything that there needs to know about mortgages. The last tip for financial planning for the 30 something, I think we can all take a couple of tips on this, is a utility review. I have more coverage on this in the shortcuts to savings. It's very topical because everything has gone so expensive and we need to make sure what we're paying is as competitive as possible. So more on that later. Okay, so financial planning for the 40 something. Pension, know your number and what is that. So I was at an event a couple of years ago and the CFO said to me, he said, "What's your number?" And I was like, "What are you on about?" He said, "What's your number? Your number is what income will you need when you retire to keep your lifestyle same as it is today." So whether that's 20,000, 30,000, know what you need, and then examine what are you doing now, today, and will you have enough when you retire? If there's a gap, plan to try and close that gap if you can. Savings and investments. This decade is the decade we see most people focusing on saving more and investing more, predominantly saving for the rainy day or saving for their children's education. Why we see more savings with this decade is your mortgage, when you took it out at the start, mightn't feel as expensive. Your salary may have increased over time, so naturally there may be more disposable income. So if you're my guide when it comes to savings and investments, I mentioned it before, you look at when do you need access to your savings. If it's less than 5 years, generally put your money on deposit. If it's more than 5 years, you have to look at investing, because I suppose the number one goal is to make sure your money keeps pace with inflation, that's not eroded by inflation. And the last tip here is know your benefits. And there's several ways of looking at this. So if you're an employee and you have benefits with work, know what they are. Some companies provide death and service, which is life assurance. Some provide income protection. If your employer provides income protection for you, treat it as a gift. It is a security blanket around your income practically forever. If you're paying for benefits privately, again, know what they are. Your circumstances will change over time, and knowing what you're paying for is making sure they're still relevant. So it's important to review your benefits. The next area is financial planning for the 60-something. So I always start financial planning for the 60-something with a budget, right? And I always look at it on a net basis. So I had a client recently, they're on a salary of 180,000 and he wanted to retire in the next 5 years, but his income was going to reduce to 40,000. So he's very, very anxious going from 180,000 to 40,000. There's a big drop. But when we crunch the numbers and we took out the main expenses that he has now that won't be there in retirement, such as mortgages and college education, the gap is very, very small. It was something like 500 euros between his core lifestyle expenses now and what those lifestyle expenses will be in retirement. So always work on a net budget basis. Succession planning, again, this is something very important. I know you're all possibly very familiar with it. The main tool that we use for succession planning is small gift tax exemption. It's a gift from revenue. You can basically give anyone, which generally goes, it's set up for children, is a gift of 3,000 per year, every single year, and it doesn't encroach in any inheritance tax thresholds. The last one is investment risk. Your investment risk, your appetite for investment risk will change over time. Obviously, in your 20s, you may be open to more investment risk. So as you get older, people tend to take less investment risk. So if you are someone in your 60s and you have investments, make sure you review the investment risk and that you're comfortable with that risk across all different types of investments. So whether it's pensions or personal investments. Okay, now we're going to go into the shortcuts to savings. The first one is budgets. Always start with budgets. I know I'm preaching to the converted. I know you probably can do budgets way better than me, but it's really, really important. The next one is mortgage review. We spoke about that already, but the most common question that I get is on tracker rates. So should I fix my tracker rate? So if you fix a tracker rate mortgage, you're going to lose that tracker rate. And I give clients the same advice I give myself. So I had a tracker rate. I had 5 years left on my mortgage and I fixed it for 5 years. Now, had my mortgage term be 15 years, I wouldn't have fixed it if I didn't have an option to fix for 15 years. So if your mortgage term is long term, I'd be inclined to retain the tracker rate. but if you can fix it for the same term of your mortgage, I'd recommend that you do fix it. Totalhealthcover.ie. So this is about private health insurance. And again, I was thrilled to see the lineup that Fiona has lined up for you in the next couple of weeks. Dermot Good is an absolute genius when it comes to private health cover. And I will be tuning into his session. If you can't make the live event, look at the recording. And if you can't do that, even just check out his website. He's some fantastic tips on how to get the best value from private health cover. I think the industry has made it so complicated and really, really hard to understand what you're paying for. So let's go to the experts definitely for that. Grants, I was going down to Ballingeary there during the week, and there were more houses with solar panels on them than not. So if you're retrofitting your house or you want to improve the energy rating on your house, go straight to SCAI, see what grants are available. They can make the costs a lot more affordable. My favorite website is bonkers.ie. It is a great tool to help you make savings, particularly in for utility bills. So I would have done my my electricity bill quite recently, and my provider said, generally speaking, providers are giving more discounts to customers to keep their customers than they were to new customers. When you're reviewing your utility bill, look at the usage charge, but also the standing charge. A lot of people forget to compare the standing charge, and that's really, really important. So if you're on the 1st of March, which you're all going to put it into your diary, so you're going to review your utility bills, first protocol is bonkers.ie. It's a fantastic website. And the last one is Serview. So I did a presentation again a few months ago, and I asked the audience how many people have multiple medias for their TV. So do they have Netflix, Sky, Prime? And I was amazed that most of them are paying nearly, over €100 on a service that's possibly available for free. So that €100 would be best served in your pension than on a service that you may or may not use. So be clever, look at the services that you're using, or if you're not using, just change them. Serview is a great service to have. So that's my top tips for the financial planning to improve your own financial well-being. I'm now going to go on to some areas that are a little bit more technical. I'm going to start off with the invest in you tax efficient. There's lots of things we can provide for ourselves, and we can claim tax relief on them. I'm going to go through them. I'm going to go through a little bit on business insurance, and I'm going to finish up with the pension landscape. So there's lots of changes and lots of good nuggets of information coming up. Okay, so the invest in you. We're all familiar that we can get tax relief when we save into a retirement plan. I'll reiterate the reliefs again. Money going in, you'll get tax relief on at your marginal rate. Your pension grows tax-free, and you get tax-free benefits when you retire. But you can also protect your income through salary protection and get tax relief on the cost of this cover. So when I'm advising a client, I always pair a pension plan and salary protection together. I ask them for a budget. Let's say the budget's €300, and I recommend they put 250 into their pension and invest €50 in providing salary protection for them. That will protect their income if something happens prior to retirement, and will also protect their income in retirement. So that's where the forever comes from. You can also protect loved ones by putting life assurance in place. And there's some type of life assurance that you can also get tax relief on. So they're down at the end. So you've pension term assurance and you've executive term assurance. I think this is a product it's underused. It's like if the government can help you pay for something, why not do it? Why would you do it alone? So this is the invest in you. If you are a company director, the company can pay for these benefits on your behalf, entirely tax efficient. If you're a sole trader and employee, you can claim your PAYE back on all these benefits. Okay, the next one is business insurance. I'm not going to spend too long on the business insurance. And the reason why I have included in here is because anytime I have a client looking for business insurance, they always say, I need key man cover. I'm like, when we have a chat and we delve down to what they really, really need, it's not always key person insurance. So business insurance is basically life assurance. You can have it in a partnership, you can have it in for directors that protects the surviving relatives, the surviving owners, the relatives and the business by putting a legal agreement in place and supporting that legal agreement by life assurance. So life assurance is really, really inexpensive. So if you do have clients who are in a partnership or have co-directors, there's no excuses not to have a proper plan in place. It can be a little bit complicated setting up, but this is my Bible to business insurance, and I'm going to share this with you with my slides. It goes through the different types of insurances. It goes through why you would need it, what's required in setting it up, particularly on the legal side of it, and and what's the tax treatment on the premium and the benefits in each case. So it's really, really a useful tool, and delighted to be able to share it with you. So if you need it, refer to it. Okay, so changing, I suppose the last bit we're going to finish up on is changes in the pension landscape. So there's 4 key areas that the pension regulator set out to make improvements with regard to pensions. Number 1 is the public sector, to have a single public sector scheme. So prior to that, you've different variations of public sector pensions. You'd have one type for teachers, another type for nurses. So they want to streamline it. Now this has started a couple of years ago, and what it is basically is for anyone that's joined the public sector from 2013, their pension would be based on a career average as opposed to final salary basis. They also looked at larger group schemes that would be set up on a single trust basis. There's new legislation came in last year. It's called IORPS 2, and this brought in new oversights in relation to pensions, oversights in relation to compliance, audit and risk. And this incurred a massive cost, or this can incur a massive cost to all single trust schemes. So in the last 2 years, the pension industry has been working really, really hard to bringing in to implementing master trusts. So it's like one trust scheme that multiple schemes can pretty much plug into. So you may not come across this very often, but you may have clients that that need to change pension schemes this year, and that's the reason for it. I'm going to go through a little bit more detail in the auto enrolment and the changes to the PRSAs, because I think they're important to know, and I think they're important especially if you're if you're dealing directly with clients. So auto enrolment, they expected, I suppose the reason why auto enrolment came in is coming in is because of our state pension. For every person that's retired at the moment, there's 6 people working. By 2050, for every person that's retired, there's only expected to be 2 people working. So our state pension is practically on stilts. But the government are proposing to implement auto enrolment so that all employers have to provide a pension for employees, and over time we'll see the state pension I suppose retreating into the horizon, and people will see their own pension as their means to provide an income in retirement. So they're proposing that it's coming in 2024. It's available for people from age 23 to age 60. It's an auto enrolment scheme, so you don't have any choice. You're signed up to it automatically. It applies to people earning a salary from 20,000 to 80,000. So if you're on a salary of over 80,000, you'll only get these benefits on your 80,000, and they won't be applied on any money after that. There is an opt-out, but you can opt out for 6 months only, and you're automatically, you can opt out after 6 months only, and you're automatically re-enrolled after 2 years. And unfortunately, they're indicating that while there'll be auto-enrollment, there won't be any changes to the PRSI taxes. So what's involved? In year 1 to 3, the employee will have to pay 1.5% of their salary, and the employer will also pay 1.5%. And the tax relief on that is 0.5. So it's an effective tax relief rate of 33%. So it's designed to make sure that employees, lower income paid employees, have a pension in retirement. Anyone that has an income over 40,000, having a pension in the normal basis is better, because you're getting a higher tax relief of 40%. And over time, they're planning on increasing the scale per my slide above. So it's something we all need to be aware of, and it's something we need to bring to attention to our clients who will be faced with these additional costs for employees in the very, very near future. The next one is PRSA. So the finance bill introduced some changes to PRSAs. Historically, any money that was paid into a PRSA, whether it be employer or an employee, are subject to income and age limits. Now you're probably familiar, you're probably familiar with them. For someone who's less than 30, they can get tax relief on 15% of their salary to a maximum salary of 115,000. So what they've done here is they've removed these limits for employer contribution. This was signed off in the finance bill on Christmas Day. So what that means is practically, as of today, an employer can contribute any amount to a PRSA. So there's no limits. So if you're familiar with to pensions and max funding rules, this doesn't apply to the employer's PRSA. So to the employer's PRSA. It's something that may be closed in the future. I do think there's possibly a time limit on it, but it could be very, very useful for company directors or people who want to put a lot of money into pensions. They can do so at the moment without limit into a PRSA, subject to having a maximum pension of 2 million on retirement. So that's it for me. I'm just going to give you a summary of what I do on a day-to-day basis. So I do a mortgage masterclass for first-time buyers. I help individuals and families provide a protection plan to protect themselves and loved ones. I do a lot of work in companies doing employee wellbeing clinics. I help people future-proof their savings, and more importantly, I love to help people retire well. And as Stephen said it earlier, this is how I do it. I only provide the advice I give myself. Here are my contact details. Feel free to connect with me on LinkedIn. Here's my regular old-fashioned contact details. If you have any questions or queries, more than happy to help you. And thank you very much.
Great, thank you very much, Elaine. That's a fantastic presentation. Some really good insights and nuggets there. And just for those in the audience, please feel free, if you have any questions, drop it into the Q&A box at the bottom. But maybe if I could ask myself something there. You mentioned when we were talking about savings and investments, and if it was something you were planning toward in a 5-year horizon, keep it on deposit, but if it was 5 years or plus to look toward investment, I'm just wondering, what kind of investments do you typically maybe recommend or see people investing in? Does it involve state investments, or is it like national solidarity bonds? Or are we talking equities?
Yeah, so as a financial advisor, when we're looking at investments, we advise in what's called a fund. And a fund is made up of predominantly 4 different types of assets. So it's property, bonds, cash, stocks, and shares. So when we're advising clients, what we do is we do a risk profile questionnaire with them to get an understanding of what risks they're prepared to take, and more importantly, what risks they aren't prepared to take. And then we try and match that fund to their risk profile. So we'd also take it a step further and we look at, have they investment experience, whether that investment experience was a positive or a negative experience, and how can we, I suppose, make sure that they're as confident and comfortable with the investment decision that they make. We'd also look at where do they have investments and where are they invested in? So again, going back to my diversification. So if you have your pension and it's with your company and it's invested with Irish Life or Zurich, then we try and diversify to a different provider when we're making personal investment recommendations. So funds would be what we would we'd recommend, and we've access to hundreds and hundreds of funds. So it's finding the right fund for you or for our clients.
I remember your example of the individual in cash for a while. Some might have a different appetite, as you say, there's others. Here, actually, sorry, yours. Go ahead.
No, and it's, you know what we do is really, really interesting. I remember having a lady in and she was well into her 70s and she wanted to go, 100% in equities. And we're like, no, hold on. And then you have your 20 something who wanted to invest in cash. But I love, I think the likes of Revolut, I know cryptocurrencies, it's something we don't advise in, but it's helped investors get an understanding of how the market works and how to invest. So it makes our job a lot easier. Before, we have to be very, very careful and make sure people understand investments and how they work. Now they're coming to us and they've got a good understanding before we even start, which is great for us.
And I've just 2 questions here. Just one of them might be more for Joey, as we say, next week, but I'll read it out. I have a tracker mortgage, which is now with Pepper. The rate is just 0.5% above ECB, which I think might be the lowest mortgage margin ever offered and became loss-making for the banks. Do you know if Pepper are accepting haircuts, i.e. offer to pay off less than the full sum owed and have Pepper settle?
Okay. You've very little options with Pepper. Pepper they manage their book. They're not there to develop their book. So while you have a tracker rate, look at you, 0.5 was, I thought 0.6 actually was the most competitive one. So well done to you with 0.5. So do they have alternative options for you? No. Are they doing haircuts? Not that I've heard of. It wouldn't stop me from asking, but from the cases that I've dealt with, I haven't seen Pepper negotiate on clearing down their mortgage. So yeah, good luck with it. I probably don't have the right answer for you, but it wouldn't stop me from trying.
You don't ask, the answer is always no, I suppose. And just another one here on pension, so auto enrollment. So if an employee already has their own pension, can they opt out of auto enrollment permanently?
My understanding is yes. If you have a pension scheme in place, you don't have to offer auto enrollment. Now, with regard to auto enrollment, government made this big announcement. There's lots of things that we're teasing out. But my understanding, if you have a pension scheme in place, you don't need to offer auto enrollment. Yes. And
you had an interesting point in there as well around if you're on the lower rate band, you could get effectively above 20% rate.
Yeah.
If you're outside of it and you're at a marginal rate, you might be as well to stay away. So it's a space to watch depending on your circumstances, it seems. And
possibly depending on the salary for of your employees. If predominantly all of them are less than 40,000, auto enrollment might be better for them. If a lot of them are over that level, then a private, company run or company sponsored pension scheme would be, they would work out better on that. Whether or not you can have a blend or a combination, I'm not 100% sure. That's something that I might come back with and I'll include in my notes. I see from the attendee, he's come back and said Pepper told me to make them an offer. Can you keep me informed? I'd love to know. I've dealt with several cases and we were told no every time. So that would be an interesting one. So thank you for your question.
Certainly, good one. And maybe if I just come back, I suppose we all hear in the papers about interest rate environment and it's increasing. I suppose, how has that impacted from your perspective, or what are you seeing with clients? Has it changed profiles or approaches, and that could be saving or debt side?
Do we only have an hour here, Stephen? Like, we could talk about this all day. There's loads of different aspects on it, right? So from the mortgage side, it's increasing the affordability on what people can qualify for a mortgage. We're finding banks pulling back a little bit on if there's anything unusual as part of an application, they are getting a little bit stricter. They're very, very concerned with the cost of living and the affordability. Lots of them, as you can see, they've increased their interest rates. But look, I leave that part of it for Joy. I'm sure he's got a lot of insight on that. In relation to the outlook of interest rates and the impact that's having on investments, you're always like, if you open up the Financial Times, you're always going to find a reason not to invest. If you look hard, there's always going to be something coming up. That's why, as a principal investor, I always my first question is, when do you need access to it? You're going to have short-term volatility all the time. You need markets to go up and go down for your money to make money, and we need to be able to accept that. Interest rates, inflation, are impacting investment returns. But we stick to the principles, benchmark against time, save on a regular basis, and diversify. Over the longer term, you can't go wrong.
Related to savings, was my question here. What does a 70-plus-year-old do with savings instead of bank deposit or national savings certificates?
That, I suppose, in terms of investing, it really depends what they're comfortable with. We'd go back and we'd do the risk profile questionnaire and see what investment funds they'd be happy with. We do offer capital guarantee investments that might be more appropriate for them. Now, I'm not a massive fan of capital guarantee. I think investments, I think the market has to be in the right place for them. At the moment, while interest rates are low, and I accept they are increasing, it increases the costs of the capital guarantee element of the investments. The other thing that they may look at is as part of the succession plan is, are they comfortable at looking at passing their assets on to the next generation? And then that opens up, I suppose, a whole different criteria, because that could be their grandchildren or could be their kids. And it's, again, what risks would that person be comfortable with over time? So I'd be very, very careful. I deposit, on-pot savings, capital guarantee options may be only the best options for them, but you really need to examine on a case-by-case basis. If they have loads of other assets, well, then they may be able to take some investment risk, but we'd be treading very carefully.
Actually, just as you're going through that, you reminded me of your succession plan piece about that small gift exemption. So if you had two parents or two grandparents, even, and if there was two grandkids, that could be three each from each parent.
Yeah.
So you could be talking 12 grand of
multiple. Yeah, I've never had so many inquiries on that in the last year. So what we do, especially when we have parents who've kids under 18, we can set up a regular savings plan. It's with an investment element on it. We set it up under what's called a bare trust agreement. So the parent has all the decision-making authority. They can decide how much to save. They can make changes to it. They can decide where the money's invested. And then when the child becomes 18 or 23, when they're finished full-time education, then the savings and investments automatically becomes theirs. The best, like, there's loads of benefits to it. One is that you're passing on assets to the next generation, and you're not impacting on capital acquisition thresholds. But they not only get the 3,000, but they also get the 3,000 plus the growth on it. So that could, like, we've had some cases where parents would save that money, but when they give it to the child, it's the amount they save plus the growth. So another
That
tip there.
value piece you were talking about in your investment, you're giving the benefit of that to the next generation then as well.
Yeah.
So an added bonus to the succession planning.
Yeah, 100%. Yeah.
That's great. I think just it is worth mentioning that piece that you'd mentioned in the PRSA and that new piece. That does sound very interesting, a new piece of legislation, which it sounds like it might suit some people, but a little caveat around timing on it.
It's an opportunity for some people. It's not for everyone. Now, there is a massive caveat on it, and I wasn't sure whether I should bring it in my presentation, but I think it's too big not to have it in the presentation today. But just be mindful with it. If you have your own financial advisor, make sure you talk to them directly on that. It's my own personal opinion on it. It's an opportunity that I don't think the Pensions Authority realised that they've opened. So I think it might be there, available for a limited time. Yeah, look, I'm going to leave. I have ideas myself on who would be really, really good clients for, but I'll leave that with you to come up with your own, I think, because it's an opportunity, but will revenue further down the line close it off, and will they go back retrospectively? I'm not too sure.
And you'd mentioned the dreaded, and I've put the 1st of March in my calendar, but
Great stuff.
And I think, you reminded me, standing charges versus day rates and night rates, and if you're on a smart meter billing, I suppose it does seem very tortuous. I suppose, what's your best tips for tackling that? Just
do it. It's not torturous. What's torturous, right, is you working really, really hard for your money and you spending it unnecessarily. I January in for mine to review my utilities every single year, and it's so easy. Technology isn't my thing. My husband's he specializes in that area, but if I can do it, anyone can do it. So the
recommended site is it
bonkers.ie, the amount of information on there, from anything to reviewing your current account to your utility bills to life assurance, everything. It's mindful, but it's important to know how to use it. So if anyone is using it and they get stuck, send me an email. I'll help you.
So just looking here and conscious we do have a bit of time, but also I think we've gone through some very insightful questions as well, and we could give ourselves a little bit of time back. So what I would like to do is thank you, Elaine, for a wonderful presentation. I hope everyone found it. I certainly did find it very insightful, and some good nuggets there to take away, as well as some good housekeeping action points for myself. But for everyone, that brings us to the end of today's session. But on behalf of the Cork Society, I'd like to thank you, Elaine, firstly, and thank all of you, our listeners who joined us here today. I hope you found it insightful, and as I mentioned at the outset, and Elaine has mentioned, this is part of a series. So next week, Joey Sheehan from MyMortgages.ie will be with us to discuss all things mortgage related. And following on from that, in the subsequent weeks, we will have a seminar on legal and health insurances as well. So you'll find the link to register if you've not done so already on Fiona's email newsletter. If you do have any questions or indeed any suggestions or requests for future events, please do not hesitate to reach out to either Fiona, myself, or anyone else on committee. We would be delighted to hear from you. But for me, for now, thanks again and have a great afternoon. Thank you.